Did you know that nearly three-quarters of Canadian mortgages will come up for renewal by 2026? This means a potential payment shock for many borrowers if interest rates remain high. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we're diving into a critical issue that's affecting the Canadian real estate market, particularly in the multifamily sector. According to a recent article by the PropMoto team, Canadian lenders are experiencing increased pressure as housing demand wanes. This slowdown is causing bidders to vanish and deals to stall, signaling a potential stress test for the country's lending model. The crux of the problem lies in Canada's short-term lending structure. Unlike the United States, where borrowers can lock in 30-year fixed rates, Canadian mortgages typically reset every 5 years or less. This creates a cyclical lending system that makes the market more susceptible to fluctuations. Nearly three-quarters of Canadian mortgages will need renewal by 2026, leaving borrowers vulnerable to sudden changes in interest rates. This structure means that Canadian banks, even with relatively small exposure to commercial real estate, face sharper financial swings. These swings are directly linked to household finances, making the market more fragile. As buyers pull back and renewals loom, we're seeing what might be more than just a temporary pause in the market. The difference between the Canadian and U.S. systems is significant for real estate stability. In the U.S., government-backed securitization spreads risk more evenly, allowing lenders and homeowners to manage volatility more predictably. In Canada, however, the short-term renewal system could lead to more drastic market shifts. Despite these challenges, there's always a silver lining. For multifamily investors in cities like Hamilton, Niagara, and Burlington, this could mean opportunities to acquire properties at more favorable prices as the market adjusts. It's crucial to stay informed and adapt strategies accordingly to navigate these changing tides. As we continue to monitor these developments, it's clear that understanding the nuances of the Canadian lending system is essential for anyone involved in real estate investment. Stay tuned for more insights on how to leverage these market conditions to your advantage. Now let's take a closer look at a new development from the Canada Mortgage and Housing Corporation, or CMHC, that could have significant implications for multifamily real estate investors. CMHC has introduced the Improvement Mortgage Loan Insurance product, designed to provide greater flexibility and financing options for both new construction and home improvements. This product aims to support real estate investors and homeowners in Canada by offering insured financing for properties that require renovations or for those building new homes. So, what does this mean for multifamily investors in Ontario, particularly in cities like Hamilton, Niagara, and Burlington? Well, the CMHC Improvement Mortgage Loan Insurance allows insured financing up to 95% of the as-improved value for one- or two-unit owner-occupied properties and up to 90% for three- or four-unit properties. This could be a game changer for those looking to acquire or improve multifamily properties in these areas, giving investors the ability to leverage more capital with lower down payments. The insured financing is based on the lending value determined by CMHC, which is the lower of the market value, or the purchase price and/or cost of construction. This offers a level of security for both lenders and borrowers, ensuring that the financing is aligned with the property's true value. For those involved in new construction, the CMHC product requires approval prior to the start of construction, with specific guidelines to ensure the project's completion and quality. One of the standout features of the CMHC Improvement Mortgage Loan Insurance is its flexible advancing options. For small or large-scale improvements, the product offers both single and progress advance options. Single advances are used for improvement costs that are 10% or less of the as-improved value, while progress advances are for costs greater than 10%. This flexibility can be particularly beneficial for multifamily investors who are undertaking significant renovations or new construction projects. Furthermore, the product includes a new home warranty requirement for all new homes, ensuring that properties are built to a high standard and are in compliance with applicable bylaws and regulations. This is crucial for maintaining the quality and value of multifamily investments, especially in the competitive markets of Ontario. For those interested in leveraging this product, it's important to note that the maximum purchase price or lending value must be below $1,500,000 for homeowner loans and $1 million for small rental loans. The maximum amortization period is 25 years, although some buyers may qualify for a 30-year amortization through CMHC's Home Start program. These conditions provide a structured yet flexible framework for financing multifamily properties. In conclusion, the CMHC Improvement Mortgage Loan Insurance presents a valuable opportunity for multifamily real estate investors in Canada. By offering insured financing with flexible terms, it can help investors manage costs and improve their properties, ultimately enhancing their investment portfolio. As always, staying informed and adapting to these new financing options can provide a competitive edge in the market. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.